So, hello guys and welcome to my channel where I translate technical accounting topics to a storytelling version, sort of. Now, in this video, I'm going to ask you, what if you wrote something like this? I, Baby G, promised to pay Papa G 1 million to be paid as follows. So 12/31/20 x1, you are going to pay 300,000. On 12/31/20 x2, you are to pay 400,000. And lastly, on 12/31/20 x3, you are to pay 300,000. And you are going to pay it to a specific person or a specific party. So what will happen next? First of all, this document is what do we call a promissory note. And a promissory note is a written and signed promise to repay a sum of money and issued to someone in exchange of something. So, meaning you have written this and you have promised to pay because you have received something first. So, it can be money, it can be services that you have not yet paid for, or it could be property, machinery, or equipment that you bought but you have not yet paid. Okay? The point is, you have received something. That is why you made and issued a promissory note to a specific party. And if you did issue a promissory note, you will have a note payable. And we are going to account for that in this video. So now, the first promissory note that we will account is this sample promissory note. So this sample promissory note is what do we call a non-interest bearing note. Because as you can see, there is no interest rate mentioned in here. But actually, the interest is already added in these payments. So this 300,000 and this 400,000 and this final 300,000 includes already interest. Okay? So, how to account for the non-interest bearing notes payable? First, you need to get the present value of the notes payable by discounting it. Because again, these payments are measured in future values already. Because again, interest is already added to them. So let's take out the interest components of these payments through again the discounting process. And to do that, there must be an implicit rate given. So that rate is the rate that is supposedly added to the payments per period. And that rate is very important because that will be used in the discounting process. So it's a must. Let's have a sample implicit rate of 12%. Okay? Now, moving forward, we have the first payment. And in order to discount it, we have 300,000 times 1.12 raised to the power of -1 only. Because such payment will be paid after 1 year. The second payment will still be multiplied by 1.12 also. But it's already raised to the power of -2. And the third and the last payment, this 300,000 will be multiplied with 1.12 raised to the power of -3 already. Okay? Now, let's get the present value factors first by simplifying this 1 plus I raised to the power of negative n's here. Okay? And we will get these factors. So these factors times the future payments, and we will get these present values. Now, let's get the sum, and we will have 800,269 as the present value for your notes payable at the beginning of the year, and this present value is also assumed to be the fair value of the products or services or the amount of cash that you have received first before making this promissory note. So, after getting the initial value, the question is, what will happen to this measurement in the subsequent periods? But before we answer that, let me tell you that sometimes the payments and this present value is given in the problem. The ones missing sometimes is the implicit or the effective rate. Okay? Now, in order to get the rate, you need to do a trial and error and interpolation. And I have a video related to that. And if you wanted to, there's a playlist link that is given in the description of this video. So you need to click that link and find it in the list of episodes in the playlist. Okay? So if we have the initial value already, then we just have to multiply it by 1.12 or 100% plus the effective rate of 12%. And you will already get the after interest amount of 896,301 minus the first payment, which is 300,000, and we will have the balance at the end of year one, which is 596,301. Now, multiply it again with 1.12, and we will have 667,857 minus the second payment that you are going to make, and we will have 267,857 times again 1.12 for the last time, and we will have 300,000 if rounded off, minus the final payment, and we will have 0. Now, let's continue the accounting for the non-interest bearing notes in the next episode to keep this video short. So if you learned, please click like, subscribe, and hit the notification bell to be updated on my next videos. So see you on my next one.